Do you know what companies like Netflix, Amazon, Walmart, or Tesla have in common? Yes, they are all part of the same group of companies called the S&P 500, and that has made many people rich. Will you let the opportunity pass you by? My name is Alex, and the purpose of this YouTube channel is to help you reach financial independence as soon as possible. If you find this helpful, please consider subscribing and hitting the bell icon. It's totally free. Now let's get back to the video. This time, I want to teach you some concepts that will help you better understand the world of money. We will learn in particular about a word widely used in the investment world, the S&P 500. It looks like hieroglyphics, but it is really very easy to understand. What is the S&P 500? The S&P 500 index is a financial product that corresponds, as with any stock market index, to variations in the value of the shares of the companies that comprise it. In this case, its value indicates the average profitability of a total of 500 companies, which are precisely those listed on the U.S. stock exchange. To be more precise, there are 505 companies listed in this index. All the companies that make up the index are divided into 11 sectors. According to the economic activity they carry out: communication services, consumer discretionary, consumer staples, energy, financial services, healthcare, industrial materials, real estate, technology, and utilities. The company in charge of generating the value of the S&P 500 is Unitronic System Corp. Founded in 1989, since then, it has offered several services related to the automation of projects, as in this case the S&P 500 index, whose value is calculated from the market capitalization of each of the companies that form it. This capitalization update is performed every 15 seconds, which means that the value of the S&P index is kept fairly up to date. The S&P Dow Jones Indices website says that the S&P 500 index moves $3.4 trillion. That's $3.4 trillion invested in funds indexed to the S&P 500 index. That's a lot of money invested in index funds. What's the point? Whether we like it or not, the US market is the leading voice in the world economy, and all eyes are on what happens there. Depending on how the American stock market performs in the last session, the rest of the markets will dance to the tune it has set. One of the main rules that you must follow to be a winner in the stock market is not to go against the market trend and try to trade in the same direction. To do this, before tracking the world market in search of opportunities, you must know what has happened in the world. Like a good thermometer, its performance is considered a reflection of the overall behavior of the stock market in the US. If it goes up, the market is believed to be in an uptrend, and if it goes down, the market is said to be in a downtrend. The S&P 500 is a very useful tool for gauging the general state of the market and making informed investment decisions. With its help, they will be able to know the temperature of the market and act accordingly. But if a mutual fund manager earns a 5% return, does that mean he has been successful with his investments? The answer is, it depends. Whether he has done well or badly depends on what we compare it to. If the manager earns 5% but the market in which he invests is growing by 10%, it means he has done quite badly. If, on the other hand, the market grows by only 2%, it means he has done very well. Therefore, stock market indices are used to evaluate the performance of investment managers, and in the specific case of the S&P 500, they serve as a comparison for people who invest in US companies. Finally, indexes are also increasingly used as a low-fee investment method. Traditional mutual funds are those in which a manager is dedicated to analyzing and selecting the companies in which to invest. This type of fund is called actively managed. On the other hand, there is a type of fund that only invests in companies that are included in a stock market index. This type of investment is known as passive management, since it does not require the study and selection of the companies in which to invest. Investment through indices offers multiple advantages, such as the fact that they have very low commissions, which historically have made it possible to obtain very interesting returns. How to invest in the S&P 500? To invest in the S&P 500, one way is to do it through ETFs or index funds because of their simplicity and efficiency. This option is fashionable, and it is not by chance, since by buying shares of an ETF you are diversifying your portfolio without complications. Therefore, if you are just starting out in the world of the stock market, you will be very interested in knowing what an ETF is and how to trade them. Another way to trade the S&P 500 index is through futures or futures CFDs, but we would no longer be talking about investment but rather high-risk trading, which you should reserve for when you have a large account at the broker and, above all, a great experience. What are the 10 most popular companies in the S&P 500 to invest in? We have already gone over the advantages of investing in the S&P 500. Now I present to you the top 10 most popular stocks that people are looking to invest in. Among the long list of the 500 largest companies, there are 10 that have the edge in terms of growth, performance, and, of course, projections. Apple, Microsoft, Amazon, Nvidia, Alphabet Class A, Alphabet Class C, Berkshire Hathaway, Tesla, Meta Class A, United Health. The average return among all these companies is 25%, which is excellent as far as percentage return is concerned. Is it a good time to invest in the S&P 500? Investing in the market always involves risk, and in times of economic recession, such as the current one, it is necessary to be very cautious. If you decide to invest, it is recommended that you not use large sums of money that could result in a personal financial crisis. Among the investment options, the S&P 500 is considered one of the safest assets compared to other financial products. However, investing in the United States and Europe remains risky. In Europe, the gas crisis has further worsened the economic situation. If one decides to invest in the S&P 500, it is important to look for options with as little risk as possible. As for whether the S&P 500 is at its best, it is not. Although many investors have been betting on this index during the pandemic because of the powerful companies that comprise it, it has been experiencing a downward trend for some time. Inflation is one of the factors that is affecting it the most, with the EU experiencing inflation of up to 10%. Companies such as Apple, Nike, Meta Platforms, Pepsi, and Carnival are losing profits because of this. Meta Platforms has frozen hiring to cut costs, and competition in the company's social media projects is hurting its shares. Past performance aside, one of the most common arguments in favor of investing in the S&P 500 is that its components earn about half of their revenue outside the US. Who needs global diversification when you have the S&P 500? You need global diversification. The fact that the constituents of the S&P 500 have global sources of income does not offer you, the investor, the benefits of global diversification. A 2019 paper from Vanguard titled Global Equity Investing: The Benefits of Diversifying and Sizing Your Allocation addressed exactly this issue. The authors showed that while U.S. stocks had the lowest volatility of any country from 1970 through September 2018, the global market cap weighted portfolio, including the U.S. and all other countries, had even lower volatility. Over the period from January 1970 to June 2009, Canadian, U.S., and international stocks had similar returns, with the S&P 500 earning 9.66%, the MSCI EAFE earning 9.28%, and the S&P TSX earning 9.42%, all in Canadian dollars. Although the US still has a small edge, a diversified portfolio with a balanced mix of Canadian, US, and international stocks produced a return of 9.84% with lower volatility than either country separately. On balance, diversification proved beneficial at no additional cost. In 2019, the S&P 500 had a price-to-earnings ratio of 20.5, while Canadian stocks were trading at 14.6 and internationally developed stocks at 14.7. This means that the S&P 500 was the most expensive market at the time, and while valuations may continue to rise for a long time, betting only on the most expensive market does not seem wise. In addition, while the S&P 500 has performed well in the past, it is not necessarily the most reliable approach to capturing U.S. equity returns. It is also important to keep in mind that the S&P 500 does not offer exposure to global stock returns, even though its components have global income streams. Compared to an actively managed fund or stock-picking strategy, the S&P 500 is very well diversified and can be accessed at almost no cost due to the sheer scale of the ETFs that track it. However, the S&P 500 is not the only index you should have in your portfolio. And it's probably not even the best index to get exposure to US stocks. Instead, the best bet you can make as an investor is a bet on the total stock market through a globally diversified portfolio of total stock market index funds. In short, although it may not make you a millionaire, the truth is that it is always important to invest your money in safe places where you can get long-term returns. If you want to learn more about money and personal finance, then you must watch this video, where I show you the 7 expenses that all rich people avoid.